Welcome back to Market on Close. I'm Caroline Woods. We have about 8 minutes left in the trading day. It's time for the big picture. Let's welcome in a member of the team from Charles Schwab. Michelle Gibley is Director of International Research at Charles Schwab. Michelle, great to have you here. You know, Michelle, it's interesting. We've talked a lot about the outperformance of international markets compared to the U.S. when we're talking equities. But when you look at GDP reports today, also the case when you compare the Eurozone GDP report to the U.S. GDP report. One was better than expected, one was worse than expected. Fill us in on what's going on in the Eurozone here.
Yeah, I think it really was interesting for both those GDP reports to come out and say same day and put them side by side. You know, and the trade war is really impacting growth globally, maybe in different ways. You know, in the headline number for the U.S. today, imports subtracted, or you should say net exports, subtracted GDP by 5% because imports really rallied a lot. They were up 41% during the quarter. In the Eurozone, we don't really have a breakdown by contribution in today's preliminary release. But as you mentioned, a headline level rose better than expected, 1.4%, if you put it on a comparable basis to the U.S. And we really probably had an increase in exports benefiting that number. Exports from the EU to the U.S. rose 22% year over year in February. And then exports to Switzerland jumped 35%. And if you tie that in with the 36% jump in chemical exports, suggests that pharmaceutical firms may have been preparing to build inventory ahead of tariffs as well. So we're getting a lot of these distortions in the data right now. If we look under the surface, individual country level GDP releases in the Eurozone suggest that domestic demand actually added to growth during the quarter.
How should investors be thinking about some of these distortions, though, as they relate to the front running because of tariffs? We had a guest on earlier today, Axel Merck, who basically said you kind of have to take the economic data with a grain of salt, not because it doesn't point to weakness, at least here in the U.S., but because it is skewed. And it seems like the Eurozone data could be skewed as well. So how should we be thinking about that as it relates to the broader economic outlook?
Yeah, I think these distortions really cloud the picture for investors. You know, these front loading of purchases ahead of higher prices could result in inventories building. We saw that in the Q1 GDP release for the US. Those would need to be worked down, but then consumers might be pulling forward purchases as well. And that maybe would reduce the amount of inventory building. And then, you know, both businesses and consumers may decide to buy a little bit less in coming months. And that could result in this vacuum of really useful economic data and add to this uncertainty about where the trends are. We are seeing in China, its economy starting to feel the impact of tariffs. We got the both the Caixin and the official manufacturing PMIs overnight. Those both eased in April. We saw new export orders falling and firms cutting into backlogs to keep production growing. And then some companies actually started to cut jobs in China.
So all things for central banks around the world to contend with. We, of course, already heard from the ECB last week with that rate cut. We have the Fed next week. So next up is Bank of Japan.
Yeah, that's right. The ECB was able to cut rates. Now, there is downside risk to inflation there. They started at 2.2% in March, and it's expected to slow. In April's CPI reading tomorrow, it's supposed to slow to 2.1%. In the U.S., the core PCE price index and the GDP was flat month over month, but rose 2.6% year over year. But data through March is really too soon to see, you know, the true impact of inflation, of tariffs on inflation. And so all of this is really making monetary policy really complicated. And it's influencing action at most major central banks. The Bank of Canada used trade uncertainty to pause in April. Tomorrow we get the Bank of Japan. They're unlikely to hike rates despite inflation accelerating there to the highest level in 2 years in the April Tokyo CPI. And really, you know, this uncertainty over where trade policy is headed is likely to slow global growth and the outlook for corporate earnings.
Okay. All right. We'll leave it there. Michelle Gibley, Director of International Research at Charles Schwab. Thank you so much.